401 class discussing mutual funds and getting a little bit further in depth with mutual funds. What?
Week 6.
Week 6.
And stocks and bonds.
Ready?
No.
Take
That
it
was
on.
last week. All right. So Ian asked me to go a little bit further in depth about what we talked about last week. He gave you an overall view of the overall investing market and the investing environment and that kind of stuff. So what we're going to do tonight is we're going to talk about mutual funds. And we're going to talk about mutual funds because those are the cornerstone of what we build for our clients and what we use when we're investing in and for our clients. Okay? So, bear with me. I apologize. So, what is a mutual fund? Well, we kind of answered that last week. And this comes from one of the handouts from that you can get on POL. Okay? I think it's the ABCs of investing. Am I right?
Yep.
No. But it gives you an idea of what a mutual fund is, right? It is, by definition, mutually funded. So there's a bunch of individuals who invest and put their money in, and then that fund is then managed and invests in what? Various investment vehicles, which can be stocks, bonds, commodities, real estate. All of these different things can make up what's in a mutual fund. Okay? Now, what is an advantage to a mutual fund? Well, it provides us with the 3 Ds of investing that we always talk about. Okay? The first D is diversification. It's somewhere around here. But diversification is what? A great way to explain it to your clients is not putting all your eggs in one basket. Because if you drop the basket, you lose all your eggs. So what a mutual fund does, what usually mutual funds are made up of anywhere between 150 to about 300 individual investments. So you could be investing into 150 to 300 different companies within one mutual fund. Make sense? So instead of having everything into one company, right, like Microsoft or LinkedIn, and I mentioned that because who knows what happened this week?
Microsoft
bought LinkedIn, right?
28.5.
Anybody know what it was per share?
$196.
$196 a share. And what was the market value, or what was it before Microsoft bought it? They bought it at a premium. It was trading at like $166 a share, right? So what happened to LinkedIn shares immediately? They shot up. Now, that's great, but you are fully invested in one company if that's what you're doing. The problem is, what happens if, how many of you remember a company called Enron? Right? People lost fortunes because they were invested in Enron. And it wasn't necessarily the value of the stock, it wasn't the company, it was the individuals and the bureaucrats and the executives who basically tanked that company for their own purposes. That is too much exposure in the market. And that's when people talk about, I don't like the exposure in the market, I don't like the ups and downs of the market. What they're talking about is being invested in one particular company, okay? That's where you get exposure, and that's where you're very vulnerable. A mutual fund provides diversification immediately because you're paying into it, and you now own and get a piece of a little bit of all of those different companies that are in there, okay? Secondly, it provides you with dollar cost averaging. Who was here last week? We talked about the cows, right? It provides you with dollar cost averaging because what are you buying when you're dollar cost averaging? You're buying shares, okay? So a mutual fund, you're actually buying shares of the mutual fund, okay? And based upon what the value of those shares is, which is based upon the value of the individual investments within the mutual fund, that's what a value of a share of a mutual fund is, okay? So if you are the third D of investing, which is discipline, if you are disciplined and buying or paying or purchasing the same amount monetarily every month, every quarter, every year, whatever it is, guess what? You're buying shares, okay? So the mutual fund is the perfect cornerstone and the foundation for taking care of all 3 of those Ds of investing, okay? So that's when we're talking about that, that's why we're talking about mutual funds for us. Furthermore, Our Series 6 and Series 63s do not allow us to do what the Series 7 allows, which is what? Purchase individual stocks, individual bonds, and get on the secondary market. Exactly. We don't work within that. Why? It's perfect for us, because what is our philosophy? Buy term and invest the difference. And who are we usually investing the difference for?
Middle America.
Families, middle America. They don't want the roller coaster ride that can be individual stocks. Okay? All right. So the next question comes, any questions about what a mutual fund is? We all have a pretty good idea of that, right? So where do we find, quote unquote, our mutual funds, right? Now you got to understand, how many of you have ever looked at, say, the New York Stock Exchange, the Dow Jones, and you've looked at stocks, okay? So you've all looked at like individual stocks. How do you look those up, say in the newspaper or online? Ticker symbol, right? We've all heard of that. Anybody know what Apple's ticker symbol is? AAPL. What's Sprint's, Jeannie? S. What is General Motors? Very good. Okay.
How about Google?
How about Google? It's not. What is it?
I don't know.
Oh, okay. Actually,
They changed it.
I know, because it became, did it become Alphabet?
Alphabet.
Yeah. So,
Sorry.
okay, so when we're looking up mutual funds, guess what? The mutual funds all have their own individual ticker symbols as well, okay? So if I know what the ticker symbol is for a mutual fund, right, I'm able to, if I want to do a little bit of research, real top line kind of research on it, I can type into Google that ticker symbol, and guess what it'll bring up? It'll bring up the actual Morningstar report that we have access to a little bit more in depth, but it'll show you all of the things that you need to research a mutual fund, right? Now, what are some of the things we research when we're looking at an individual company? Ian talked about it last week, right? Price to earnings ratio, right? He looked at, you look at management. Maybe you look at historical performance. Maybe you look at historical data. Maybe you look at future data. What's coming up? Who knows? Who knew that Microsoft was going to purchase LinkedIn? I bet you there were some people that knew, right? And they did that by their research and knowing that. So when we're looking for mutual funds and we're researching our mutual funds, the first thing we need to know is obviously the ticker symbol. And you'll be able to tell what kind of a mutual fund it is, right? Based upon usually the name, right? So if I call this the ClearBridge Aggressive Growth Fund, guess what kind of a mutual fund it is? Aggressive growth. Thank you. Let me take this.
Risky.
Sweat. So that's where you're able to get together these mutual funds, okay? I tried to think of what is a mutual fund? What can I liken it to? How many of you are basketball fans? Okay? How many of you have been watching the NBA Finals, right? Cleveland Cavaliers against the Golden State Warriors. Two very different teams. Am I right, Travis? Yes. Since you played pro ball overseas, I'm going to go to you, okay? So two very different teams. What would you characterize Golden State as? Run and gun? Come across half court and shoot it, right? That's what they are, okay? So that is the characteristic of the team. Cleveland, a little bit more defensive minded, right? They rely heavily on two players. Last night, Kyrie Irving and LeBron James scored 82 of the 112 that they scored total, okay? Now, if you liken that, right, what is that team made up of? Individual players, and each of those individual players have their own set of specific skills or characteristics, right? And when you put all of those together, you're hoping to get a successful team. All right? A mutual fund is the team. Okay? And it's made up of individuals or investments, right? And each one of those different individual investments has their own individual characteristics. Some are more aggressive companies, Luann. Some are bonds, which are very conservative. Some are real estate, which can go up and down. Some are gold, which are all over the place, right? But that's all made up of, that's the individual team, okay? So when we look at a mutual fund, think of it as a team, And our job is to look at what it makes up that team, right? We've got to know all of the players. Sometimes that's difficult because now all of a sudden you've got 150 players minimum to look at, but you're going to be able to look at least the starting 5, okay? And the starting 5 is indicated within the mutual fund report of what? What does the mutual fund manager or the coach, right? What are they mostly investing in? What are the top 5 individual investments that they're investing in, right? It could be, we'll look at a couple of them, but it could be an individual company, it could be a commodity, it could be real estate, okay? And that will give you the makeup of, that mutual fund, okay? So that's when you're starting to think about that. Now, if you,
Now, if you think about this little pencil.
Wow.
I
went ahead and
That's the way. Okay, so as we're looking at, those mutual funds, I want you to think of those as the team. And what I want you to think about as well is as we are getting the individual characteristics of those teams, that's what makes up, if you will, the divisions or the conferences. So there are several aggressive growth mutual funds. There's 5 in there. That makes up one conference. The overall league itself is what I would call the investment company. Okay? So, where do we find our mutual funds? Well, you've all seen this, right? You've seen the presentation. You know that we partner or we have relationships with this area here. American Funds, Franklin Templeton, Invesco, Legg Mason. They are the investment companies that we work with, right? Remember, they want to work with us. Why? Because of our distribution, right? They have now more agents who are going to be putting out their individual products than they have in-house, okay? So these are the areas, these are the companies that we work with. Sometimes you'll increase it and you'll do some more investments with like Lincoln, AXA, MetLife, but those are more on the annuity side, okay? That's a little bit different. So you've got these companies that we're working with. Now, these companies,
Which one's a platform and which ones are not?
well, I'll get to that, okay? So, what we're talking about is what individual companies are we working with? Are there other investment companies that we don't work with?
Yeah.
Like
Yeah, of
what?
course.
How about Fidelity? Yeah, we do Franklin, right?
That's up
Vanguard.
That's up here. Vanguard, we don't work with. How about Prudential? All of those kinds of. Right. Okay? So these are the companies that we work with. So these are the only, if you will, conferences that we're working in. Okay? Where else do we find? As we drill down a little bit further, we'll find what this is. This is a list of approved mutual funds that we work with, that we can work with when we're building our portfolios for clients. Okay? A portfolio could be one mutual fund. Portfolio could be 10 mutual funds. Okay? As long as they're on this approved list, which you can find where, Joe? POL.com. But you've got to have your securities license before you can get those approved funds. Now, what I do, and what I tell everybody to do, is these update on a monthly basis. So the first of the month, I always go in and I print these out. Okay? Sometimes it changes, sometimes it's exactly the same. Okay? This will also give you an indication of what Luann was talking about, okay? Which are platform versus non-platform funds, okay? Or platform versus non-platform companies that we work with. Give me an example of a non-platform company.
American Funds.
American Funds, Luann's favorite. American Funds are a non-platform fund, which means they haven't gotten as in-depth as the others have, and we have to do additional what?
It's a delay because is of the paperwork, and if it's not in good order, which is my fault, don't worry. I deleted it.
That's my goal today, to expose Luann.
No, okay, if you're with a platform, it's all in a turbo app, and you can't be not in good order.
Correct.
But when you're with a paper app, you can cross something out and not initial it and date it correctly. Just you do some little thing, and see the company that you're trying to roll that money away from is going to find every reason to stall, and they won't tell you why it's not in good order. And so this is the nature of it. So from now on, I'm looking at
We gotta cut that piece out.
No, it's absolutely right. The non-platform versus the platform fund. Platform funds are a lot easier to work with from an individual's perspective. However, the non-platform funds, sometimes you get better returns, sometimes you get better performance with a lot of the funds that are offered on non-platform. So in the best interest of the client, do the additional paperwork, get it right, make sure it's correct when you submit it, and it goes in. Okay? All right. So you see, what's nice about this is it gives you, it breaks it down individually for each company. So this is Legg Mason. This is the first page for Legg Mason. And you see they give you the sales desk phone number and the investment category. Now the investment category tells you what kind of a mutual fund you're looking into, right? Here's first one, money market funds. What's that? It's a money market account, just like a money market account at a bank. Okay? What are they investing in? Usually nothing, right? It's just all cash, and they're paying a return. Then you've got taxable bond income funds, okay? Then you've got tax-exempt bond funds. Then you've got, further down, balanced funds, large cap equity fund of funds, okay? Then you've got small cap, then you've got international, then you've got, mid cap, all these different things, okay? Those give you an indication of what? Risk, volatility. What else? How about what they're invested in, right? Okay. What else? Potentially, it could give you an indication of length, right? Because I bet the large cap, those mutual funds have probably been around a little bit longer than the small cap. You're all looking at me. What does CAP stand for?
Capitalization.
Capitalization, which is what?
How much money that the individual companies they're investing in, like big companies or little companies.
Correct. And how much they're making. What is the minimum? What is the maximum that a small cap company can make? Joe, give me. I think it's 100 million. So when we say small cap, we're not talking. They made $1,000 last year, right? They made 100 million maximum. Okay. Then mid cap goes from 100 million to
Billion? I think 500.
500 million.
Is this revenue or?
Yes. Yes. Okay. And then large cap is 500 million or above. Give me an example of a large cap company. Apple, General Motors, IBM, General Electric, Google, right? Microsoft, okay? Usually, these are making a ton of money. And they're usually very stable because they don't have necessarily a huge potential for growth. They're on the high end of their market. Now the small cap companies, those under 100 million, right? Those are your startups. Those are your LinkedIn 10 years ago, okay? And what is the problem? Not a problem, but what is the risk involved in a small cap company?
Very high.
Very potential for failure, right, okay? But on the other end, great potential for growth, right? Imagine if you would have bought Apple 15 years ago, right? Now it's huge, okay? So when you're looking at these mutual fund classifications, guess what the volatility in a small cap mutual fund is? Pretty high, right? And large cap, pretty low, right? What else has a low volatility? How about a bond fund, right? How about a treasury bond fund? Backed by whom? The United States government, which hasn't failed yet. Okay? But what's nice about this, with all of this information, you're able to look at and do research on your own. Okay? It's a very complex thing. But if any of you played rotisserie baseball or rotisserie basketball, right? Where you had to check out all the stats. I'm amazed, you know, I got 8 and 7-year-old nephews who know all the stats for every Chicago Cubs player because they live in Chicago and what they do. I have no idea. But they've done the research and they know that, just like I know that within the aggressive growth, you know, the #1 industry is healthcare. Okay? So, this isn't easy, understanding all of this. But if you have that basic understanding, you can continue to do the research. Okay? What are these? Ticker symbols, right? And what is our favorite? Tracks, right?
Why is that our favorite?
Just shut up. Don't ever question me, Jordan. No. Schrax is from Clearbridge, which is through Legg Mason. They are a very aggressive growth fund, okay? And they've been around for at least, how many years? 31, 32 years. And in that time, in those 32 years, they have averaged 12.1% return. Average. Now, here's more research that we've learned. The manager of Schrax, or the coach, is a guy by the name of Richie Freeman, and he's the one who has steered that fund to 12.1% every year, or average, for the last 30 years. That's a pretty good track record. That's another reason it's a nice favorite of ours. Okay? And if you are looking to, say, start a PAC for a Roth IRA, why would I start a PAC with 15 different mutual funds? Okay? 15 different mutual funds.
Oh.
I'm diversifying all the way across the board, right? Why not stay within one fund and really, really intensify the small investment that I'm making within the PAC? Okay? All right? So, we know where we can find the ticker symbols. All of these that are on that list are approved. We can't work in any other ones. Like if we wanted to go into the Vanguard, you know, index fund, which you'll hear a lot about when you get into this business and into this game, index 500, we can't work in that. That's not approved. Okay? Questions? All right, good.
Now, this is all you need, isn't it? Really? You don't need the off-platform. You don't.
Well, you should.
Or Invesco, between Invesco.
You should be aware of what are platform funds and what are non-platform funds. And I only say that because you need to have a good, diverse thought process when you're looking at all of these different funds and making up these portfolios for your clients. Okay? Yeah, Matt.
You're saying we don't have access to the Vanguard index fund, or we don't have index funds?
We have one index fund,
Right.
and it's a weighted index fund. Okay? And I'm not going to get into what a weighted index fund is. Everybody know what an index fund is? An index fund, okay? Index 500, it's basically, it invests in the S&P 500. So it takes the McCall's money and it just puts it into this fund and it follows the S&P 500. And whatever the S&P 500 is, it takes, say it's $500 that they invest, $1 for every one of the different funds that they're in. Or every company the 500 are in. Okay? Guess what? There's no what?
Management.
There are little fees, but there's no management. Right? I could manage that fund.
Yeah.
Right? You could manage that fund. Because all you're doing is taking the money, and whatever the S&P 500 is, that's what you're invested in. Okay? And it follows the market.
It'll never beat the market.
It'll never beat the market. Why?
The only follower to get
It never gives the opportunity to beat the market. In fact, it'll never beat the market, and it'll be just slightly under the market because of
Fees.
fees. Now, the fees may be like 0.2%, maybe like 0.5%, whereas the managed funds, your fees are 1.2, 1.5, maybe even 2. But If I'm beating the market by 3 or 4%, and the fees come back, I'm still beating the market. Okay? So we'll get into that later on because you're going to get that argument. Well, why don't I just take all my money and dump it into the index fund? Right? And if you do some research, unfortunately, there's a good argument for that from a guy by the name of Warren Buffett, who 10 years ago had a bet with one of the hedge fund managers, a guy who had his own fund, who said, all right, I'll bet you $1 million that after 10 years, the index fund will outpace your fund. Yeah. And the guy took the bet. The hedge fund manager said, absolutely, we'll take that bet, no problem, right? Now, this was in 2008. So guess what? The hedge fund manager starts out and kills him. Because what happened to the market in 2008? Crash, right? Now, we're, what are we, 8 years later? The guy wants to get out of the bet. He said he'll pay Warren Buffett like 750 grand to get out of the bet. Why? Because the index fund is now killing the hedge fund. Well, not killing it, but it's 2 or 3 points ahead. Why? Because the market came back. The hedge fund manager and his people, although they did really well out of the gate, over time, it's tough to beat the market.
It's time, not time.
Somewhat, yeah. It is. Okay? All right. So, I have copies of this. If you guys ever want this, I know some of you don't have your securities licenses, but if you ever want this to do some research, to get an idea, I've got copies of this. I think Joe does. Most of us that are securities licensed, if you've been in that class with me, I've recommended that to get this. Okay? This is almost like your encyclopedia, your almanac. Okay? All right. So now that we know where they are, what are the varieties? Spell that right? Varieties of mutual funds. Aggressive growth, growth in income, moderate growth, conservative growth, income. Why? Why are there so many different opportunities and offerings of mutual funds?
Based on the client's needs, wants.
What is the answer to every question you get with investing?
It
Joe?
depends.
What's suitable?
It depends, right? Because we need to know what is suitable. I'm not going to put some 84-year-old lady and her life savings, right, her $1.5 million into Shracks when it could drop tomorrow and have half the value, right? Why? Because an aggressive growth fund needs what, Luann?
Time.
Time, right?
So it's good for 20-something.
So what will we look at with 84-year-old lady who's got $1.5 million? Probably
She needs
income. What are the 3 ways that mutual funds provide income or provide growth?
dividends.
Dividends,
Interest.
appreciation, and capital gains. Okay? So if we put her into an income fund that is mostly companies that are kicking off dividends, guess what? She can draw income from that, and their principal never goes away. Because Jesse, what if she's making on that income, very conservative income fund, what if she's making 5% every year, conservatively? On $1.5 million? That's pretty good.
Obviously not gonna live off.
But she's drawing income, or she's drawing off of it at 4%.
Right, she's actually gaining money over time.
She is, over time. Okay?
Why
Yes,
would-
Jack?
Why would you want to put someone so old in a fund when she has so much money?
It's gotta go somewhere.
It's
I
it's gotta go somewhere, that's a good point. B, it depends. Because maybe we could put her in the bank. But what's a bank gonna earn?
Nothing.
Right.
But that's a lot of money at 84 years old.
Well,
Well,
I
right, but if she
understand.
can.
But why not protect that? Because if she's making 5% and drawing 4%, guess what her principal never does? It never goes away. With the bank, it's not making anything, and let's say it's making 1%, and she's drawing 4%. She's losing 3% a year.
Putting inflation.
And what if she lives to 150?
It's just the client's best interest.
Exactly. And that's why I always say it depends. It's suitable. Josh Agini's needs are very different from Joe Esdale's needs.
I don't know about
I don't care to know what Josh Agini's needs are. However, I'm assuming, and I apologize for assuming, they're very different from Joe Esdale. As Joe is blushing. So is Agini. So these are the differences in those mutual funds. You'll see the classifications. You'll see them when you look at those approved funds. Okay? And usually the name of the fund will give you an indication. All right? So, how do we read a mutual fund report from Morningstar? Now, this is where we're going to get really, really nerdy. Okay? This is what I'm good at. Right? So, first of all, what the hell is a report from Morningstar? What is Morningstar? Matt?
It's a third-party company that just reviews the funds of the other companies and gives
The key in that sentence is third party. They are an uninterested third party. They have no interest in the mutual funds that they are rating. What would that be? A conflict of interest, right? So Morningstar is a third party rating service that reviews all of the mutual funds, right? And then they put their reports together. We, when you become securities licensed, 6 and 63, have access to Morningstar. Typically, when you get access to Morningstar, what is it, like $4 or $5 grand a year for the subscription? Primerica provides that to us for free. Okay, so get your license. So what are we looking at? All right. So what I did was I pulled a few of my favorites out here, and we're going to look at these. This is a Morningstar report. I hope you all can see it. You can get this. I'll put it online later. This is the Invesco Diversified Dividend. This is LCEAX is the ticker symbol. That's how much I like that. Now, what do we know about this, Jacqueline? Diversified dividend. Where does most of its value come from? Companies that kick off dividends, right? I have a question. Does a company have to pay a dividend?
No.
Who decides whether a company pays a dividend or not? The board of directors, right? And why do they typically provide a dividend? To keep who happy? Shareholders. Absolutely right. Okay? And they're adding value to being a shareholder in the company. Okay? Well, the mutual fund, because it is a collection of companies that are kicking off dividends, guess what they kick off? Dividends from those companies. Okay? So, a couple areas that we always want to look at, right? This is from 2005 to 2016, like May of 2016. Over here, you've got the history, right? What I look at is total return percentage. So it's this line across the board. And you can see the pattern of what's been going on, okay? Now, never, ever, ever sell exclusively or talk exclusively about the return on a mutual fund. Why?
because it changes.
It's never, exactly right. It's never guaranteed, right? And to look at only the return is to only look at a very, very small portion of the overall fund itself, okay? It's like looking at a company's HR department only and trying to value it as a company.
Is the ticker USD?
No, those are US dollars,
Oh, okay.
okay?
What's the ticker?
LCEAX. Yep. So the total return in May of 16 was 6.8, 1.79 in 2015, 11.83 in 2014. Now we're talking 29% in 2013. Wow. 17.17 in 2012. Negative 0.2 in 2011. It's a cross. So 5.12 in 2010, 2009, 23.66. Whoops. 2008, negative 25.95.
That's one of the top performing funds.
Historically, right? Historically. Okay. So look at that. You'll also be able to compare it to what? The pink is the Invesco Diversified Dividend. The green is, what the hell is that?
You can zoom in on that, no?
That's the S&P.
It's beating the S&P.
That's bottom of the S&P, right?
Yeah, the blue is the S&P, so it's outperforming the S&P. I think the green is the industry that it's in, or the sector that it's in. Okay? So that's one thing to look at. Another thing that I look at is, immediately, you'll be able to see what the portfolio is made up of. Blue is stocks, pink is non-US stocks, and orange is cash. You'll notice that there's no bonds in there, and there's no other, right? So, I mean, that makes sense, right? Because it's a diversified dividend company. Bonds don't kick off dividends, do they? Commodities don't kick off dividends, do they? So it'd all be in stocks, US and non-US, okay? That's a great indicator, quick indicator to show your client what it's made up of, okay? The other thing I like to look at, remember we talked about the starting five for the team? Right here. This is a percentage overall of the assets that are purchased within the mutual fund. Number one, General Mills is your LeBron James of the diversified dividend, or the Steph Curry, whatever you want to, whichever one you want, right? Number two, AT&T. Number three, Coca-Cola. Number four, Campbell's Soup. Number five, Exelon. And okay. Now look, as we go further down, the Hartford Financial Services Group, Heineken. Yeah, everybody likes that one, right? The Kraft Heinz Company, Suncor Energy, and then PPL Corp. Right? You want to do a little bit more research? Go look up what PPL Corp is. Right?
So Dave, you look up every one of these companies?
I look at every one of these mutual funds. Yeah. But what I'm looking at, Jordan, is I'm looking at what are the top 10 offerings and what are they buying, right? Because a lot of times this doesn't look like last year's report. They may have been buying more Coca-Cola last year. And this percentage, so 3.42% of the overall fund is invested in General Mills. 3.01 is invested in AT&T out of 100%. Yeah. Okay. So you can imagine if there are 150 companies in this fund, imagine what the 150 is like 0.001% make up. Now that could still be 10,000 shares.
So you look at the
I look at the top 5, actually top 15, to see what they're investing in.
Total return percentage.
Up here.
Yep. So you go in, right? You open.
Yep.
You look at the total return percentage.
Yep.
Then you look at where their portfolio is.
Yep.
Okay.
Analysis.
Then you look at the top 5 companies that they're in.
10 companies. Yep. Exactly. It's giving me an indication, right? It's like, Travis, it's like a scouting report, right? What do I know about this? Well, this fund can't go left and doesn't like to shoot off the dribble. I don't know, I'm just throwing stuff out there. But we know this fund likes to invest in mostly U.S. stock companies, some international companies, stock companies, Heineken, right? And it looks like their industries are mostly what? Food services, right? With some telecom in there. Okay? Now, you talk to a client and you start telling them, I love this LCEAX Diversified Dividend Fund because it invests in large cap companies that have kicked off dividends for the last 50 years. What's nice about that is the appreciation rate is increased because of those dividends, which are reinvested in the mutual fund. Look at Anna, she's like, what in the hell are you talking about? Right. Now, sure, baffle them with BS, but what you're talking about is very, very correct. I mean, it's correct. And guess what it adds to your credibility? You know what the heck you're talking about, right? Because you've done the research. right? How many of us have a specialty? We like a hobby or something like that. You know everything about it, right? Make this your hobby, because this can make you some money. Okay? All right. So, and so can life insurance. Because my next question is, Joe, how are we going to protect these investments? Exactly. Let's talk life insurance, right? Because I notice you don't have a policy. All right? Okay. So another thing, Jordan, that I like to look at.
Is this dog?
My dead dog.
This cute little guy right here.
Hey, life is harsh. Get over it.
Suck it up, Buttercup.
That's right. Shit. So anyway, the other thing you look at are the sectors, right? Now, the sectors that you look at are the industries that they're involved in. Remember we talked about, we've got basic materials, consumer, cyclical, financial services, real estate. Those are the top 5. And that's proven based upon the companies that they're invested in, right? The other thing I look at, I don't know if it's in here somewhere. Stop it. No. It's the manager. No. Usually they have, where the heck is it, Hodo? Is it on here?
Keep going down. Manager, multiple operations left.
The one thing that's not on here, but you can find it on the Morningstar, the public that you look up, who is the manager of this fund? Okay? Is it on it? It says multiple. Usually there'll be one head manager and then assistant managers. Okay? And you look at who's been there and how long have they been there. Right? Because if historically this fund has made, let's say 10% over the last 20 years, but George is the manager of the fund and he's only been there for 3 years, what was going on for those other 7 years? Who was there? Well, Jeremy was there, and you know what? He left. Well, why did he leave? We should figure that out. That's why when we talk about Stracks, again, Jordan, and you've got a guy who's been there for 30 years, he's been managing that. His record over those past 30 years is 12.1% per year historically. That in the industry is, that's like having Pat Riley or Phil Jackson or somebody.
John Wood.
Vince Lombardi, John Wood, absolutely.
So if he-
Mike Krzyzewski, Dave Weeney,
If he leaves,
Yep.
That changes everything.
If he leaves, it may change everything.
He's got a co-manager.
But what if he's got a co-manager? What if he's got an assistant manager? George may have been there for 20 years, but he's only the manager now for the last 3 years. But for the previous 17, he was on the team. He was part of the coaching staff that got them to that point. So you say, oh, okay, maybe this kid is the Tyronn Lue of Cleveland Cavaliers.
wow.
Right? So we're looking at that, okay? And it's always good to find a manager who's been there, in my opinion, for at least 10 years. Why 10 years? What was 10 years ago? What year? Do the math again. 2006. So they were there for a good year, good couple of years, and then what happened? They were there for the bad years. And then they were there for the recovery and the good years. Okay? So they've got some history, they've got some track record, they've been through the ups and the downs. Okay? That may change as we get to like 2019, 2020. Because now I'm going back 10 years and it's only 2010. I want to see how they respond to adversity. And I know that's a pretty small word for 2008, adversity, yeah. Okay? And how they did. Yeah.
The Morningstar report, does it only go back 10 years?
No.
No.
The Morningstar reports will give you a number from inception, meaning when did the fund start? I thought I was talking dirty, didn't you? Yeah, sure.
People toss around the word beta a lot, so This one says 0.74, yeah, that's like risk tolerance or?
Okay, you throw the word out at me, what is the beta? Okay, no, it doesn't. Now, we'll get into that later on. And those are other things that we're gonna talk about when we're talking about mutual funds, okay? There's an alpha measurement and a beta measurement, okay? Beta measures volatility in comparison to the market.
And that's
Okay.
how Ian uses beta to
Right.
steal all the funds.
To all the funds, right? Because he'll say to you, he'll say, well, you know, I've been getting 10.5% in my mutual fund, right? And Ian will go, yeah, but what's the beta rating for the last 10 years? What? Now, if the beta rating is 1.5, guess what? That's a pretty volatile, right? Pretty volatile portfolio, okay? So when we're talking about the beta, we're talking about volatility. So when you see 0.74, that's a pretty stable, right? That's another reason that I like LCEAIs. When we're talking about alpha, all I'm going to tell you about alpha, and I used to use alpha all the time, but then I saw the light, and all alpha is, it's a measure. Do you see the light? No, I know. I just watched the Blues Brothers. Anyway, so the alpha is just a measure of the performance of the manager, right? Because I kept going through these alphas and they're like negatives. I'm like, this can't be right. But it's a measurement of the manager's performance. So it really has no relevance necessarily, especially if that manager has only been there, like George, for 3 years. So always, always, always fall back on the beta. That's why Ian does that.
Thanks,
Okay?
Dave.
Yep, sure. Good stuff.
Should the manager make?
Dave, how much do the manager make? How much do managers make?
They're good.
It does depend. Sometimes they're based on their performance. Sometimes it's based upon a salary plus performance. Sometimes it's based strictly on commission. So it is in their best interest to do,
It's usually the largest
and they are usually the largest holder,
expense. Usually
the largest expense. But you're also looking for managers who are invested in their own fund. Richie Freeman, he owns what, 100,000, 200,000 shares of his mutual.
Salary into it.
Yeah, just buys his own
How do
funds.
you know that?
Research. It won't show it on Morningstar.
Just Google.
Google it up. Yep. You'll be able to find all kinds of stuff. Now here is Schrack's. This is a little bit different. Look at this. So 2005, 12.5. 2008, down 42.4. Makes a big recovery in 2009 to 32.6 and 2010 to 23.9. Okay? We look at, what else do we look at? The mix and the makeup. Mostly what? U.S. stocks. And what is it invested in? United Health Group, Biogen, Allergan, Comcast, and Amgen. Anybody know what happened to Allergan recently? Merged and was bought by Viagra. Company that makes Viagra. What is that? Pfizer.
I know that, Dave.
Pfizer bought it.
Research.
What does Allergan make?
Google, let's not go up.
Yeah. It's hard to tell.
Stay up for longer than 4 hours.
Yes. Yes.
Insider info.
Allergan. What the hell is Allergan? Do you know? I looked you up.
It's contacts and.
I thought it was more for. I thought it was more for like cholesterol. Anyway, the merger.
Make a lot of chemos.
There you go. Now, I point this out because Richie Freeman, 5 years ago, completely, and this is Richie Freeman's fund, he completely shifted all of his purchases and what he was buying 5 years ago. Why? What was looking to come into effect? ECA and Obamacare. And he calculated that the whole healthcare industry was going to get turned upside down, which it Kinda did. And he has since profited in the fund for it. Okay? So look what else he's invested in. Facebook. Right? Tyco. We know about that one. Okay? Alright.
How often can they switch what they're invested in? Like how?
Well, that's a good question, Jesse. There is a rating or a category on Morningstar called what?
I don't know.
It's called turnover, which is how often. Yeah, I'm the only one who's nerdy enough to know exactly. Thank you. Smart enough. Yes.
Fill in the blanks.
No, it's called turnover, right? It's like looking at a team, and again, I go to you, Travis. How often do we churn through players, right?
But they're allowed to pretty much as frequently as they
Absolutely.
want. Okay.
Now, here's the problem. Here's the problem. Well, every time they sell, guess what? There's an expense, right? Every time they buy, there's an expense. It goes towards the fund, which reduces the return. Okay. Now, you look at a company like Berkshire Hathaway, right? What is their per stock price? Anybody know? How much? $195,000 a share. Why?
Warren Buffett.
Because they've never split, right? They've never sold, right? And all he does is buy and hold.
Why do they split?
To make it affordable.
What?
To make it affordable.
To make it affordable. Even but at $200,000 a share, great. We split, and now it's only $100,000 a share. But what if the share price is $100 a share? We split it. Now more people will buy it at $50 a share than they will at $100 a share, which raises what? Capital for the company. And we're talking about individual stocks. Mutual funds do not split. Right? Mutual funds are what they are.
Is there a level that they split it? Can you just get to 100 and split to 50?
It depends. There can be several splits. Like if it gets, they split it at 100, it goes to 50, and it goes to 100 again, and we split again. Okay?
But the shares in the mutual fund can split.
Yes, they can. The companies.
But you won't see that.
But you won't see that.
Gotcha.
It's not as if the shares of the mutual fund
It's not
are going to split.
So you could buy a mutual fund or invest in it, right?
Yeah.
And then next month it's completely, the main category or next year is different.
Yes.
Okay.
But, excuse me, again, you're relying on, it's like when you fly, right? What is everybody counting on?
The pilot.
The pilot doesn't have a death wish, right? And he's going to get us all there safely. Same thing with these managers. Okay? We make sure that, and we look at their track records. Now, Jordan, you may go into this and say, oh, I see Richie Freeman, he turns that stuff over every year. Okay, good. That's what I'm to expect. Okay? So, continuing along, this is Western Assets Managed Municipals. Jesse, what does this invest in?
Looks like mostly something not volatile at all.
Correct.
It's slowly going up.
Municipal bonds.
Bonds, yeah.
What are municipal bonds? Very, unless you invest in the city of Detroit. Municipal bonds. We talked about it last year, or last week. A bond is a debt. You're the bank. You're buying, you're loaning the municipality money. They're going to give you a guaranteed interest rate. That guaranteed interest rate is very stable. So this isn't going to go up and down very much, right? And it's a nice fundamental foundation to have. What else is great about municipal bond funds?
Tax-free.
They're tax-free. Now,
They grow tax-free.
they grow tax-free. When you take the money out, they're tax-free. Right?
Who needs that?
Who needs that?
Operation.
Everybody!
Rich people. Rich people.
No, who needs that?
Operation.
Jacqueline, let's go back to our $1.5 million 84-year-old lady, who was very attractive, by the way.
Oh, yeah, right. Oh,
Now, let's say she doesn't want to get invested in like a qualified fund or anything like that. We could put, yeah, I'll convince her. we put her into this municipal, tax-free municipal bond fund, and she's making absolutely no, she's paying no taxes.
Distracted now.
And what do these usually pay, Phil? And they've historically paid 3, 4, 5%. There it is. It grows at 5%, tax-free. She takes it out at 4%, tax-free. Principal never goes away.
She's happy, you're happy.
I'm happy.
They've made her happy.
I'm so happy. Push her in there. What? All right. You know, you'll be able to see this.
100%
It's all
bonds.
orange. It's all bonds. Okay? And look what it's invested in. MSR Energy Authority. I don't know. Texas Municipal Gas Acquisition. Public Authority. Atlanta, Georgia Water and Waste. Water.
Basically things that will never go away and we always need.
And we always need, and we always pay for. Ask the people of Flint about the water, right? Always pay for that. All right? George is over there.
George is over there, he'll tell you all you need to
You
know.
better not have imagined that. All right, and here's a final one that I put up there, which is the Invesco American franchise. Right? Let's look at what they're invested in.
Bonds. Or no?
Non-US stocks. Alphabet Inc. Ovi, what's that?
Google.
Google. Amazon.com.
Oh wow.
Apple. Facebook. Lowe's. Gilead Sciences. Microsoft. Philip Morris.
Lowe's doesn't belong.
Those are all non-US.
Those are US stocks.
That's US stocks. I don't know why it's that. I must have run out of ink.
Now,
I'm going to bring up something real quick because I know we're going to get out of here. But listen, I've had clients who have said, what is this mutual fund invested in? And when I showed them that they were invested in Philip Morris, Exxon, and Baby Seal
They
Killers,
don't want to do it.
they didn't want to get involved. It wasn't Baby Seal Killers. But they didn't want to get involved. You may find, and that's why it depends, you may find the best mutual fund. And I say, Bo, this thing has made 17.5% for the last 150 years on the backs of tobacco industry and the oil industry and styrofoam and the marijuana industry, right?
And the plastic rings.
And she says, you know what? No way, Dave. I'm not supporting that at all. So that's why it's important. Now, let me give you one more thing before we get out of here, because I had some more. I have all of this information. This is from our friend in New Jersey. No, Pennsylvania.
Oh yeah,
what's
Ben
his-
Shepherd.
Ben Shepherd. Okay, I have a copy of this. These are Invesco portfolios that he puts together at various things. This is from Legg Mason. It's the fund recommendations that they have. And then also you've got your Ibbotson model portfolios. We can talk about that later. One thing I want you to know is some resources, okay? No, it didn't give everything. All right, resources. Where can you find some information about this stuff? Your RVP and your upline. Anybody who is securities licensed here will share with you any and all information, any questions you have, okay? But don't come to them and expect them to be Google and give you all the answers. Do some research beforehand. Where can you do that research? How about the Wall Street Journal, right? How about Yahoo Finance online? I have an app on my phone. You all have an app if you have an Apple phone, right? The first thing that comes up is stocks. You can watch what stocks are going up and down. Guess which one stock I look at all the time? America. Right? And I'm an idiot because I didn't buy it when it was at $17 when it came out with its IPO. Because what's it at now? 57.
56, 50.
I didn't make $40 a share. Now, okay? The other things I want you to look at and potentially get into. Look at, like, there are publications called Financial Times. Okay? And there's another one online called investing.com. That will give you stuff across the board. Get your hands up.
Just let it happen.
It'll give you stuff. That's what he told his wife 10 months ago. Stephanie, listen. Use those resources when you're going to do your research. And then if you have questions, talk to an RVP, talk to somebody in the securities license. Okay? If you have questions, I'll hang up.
Thanks, Dave.
Thanks. Let it happen.
Sit back and let the good times roll.
It'll be the
It'll be okay, just let it happen. Yep, just let it happen.
Google.